Welcome to episode number 3 of Understanding the Wall Street Blockchain Alliance Crypto Industry Principles. I am your host, Ron Quaranta, chair of the Wall Street Blockchain Alliance. Before we begin and introduce our guests, please keep in mind, as we usually say, nothing discussed is accounting, investment, legal, or tax advice. And our guest today, dear friend and colleague, Mr. Greg Murphy. Greg, say hello. Please let the audience know who you are and what you do.
Oh, hi, Ron. Thanks for having me. Appreciate it. I'm involved with the WSBA and the legal working group, and I was delighted to be a part of this, my crypto principles paper. Excuse me. I've been 35 years in capital markets in various roles, and then most recently with a company called Blockbank, where I'm the CFO. Blockbank is a DeFi, CeFi, and banking application. So, but a lot of time is spent. The least interested time is spent with regulation, both in the U.S. and Canada, where I'm based. I'm based in Toronto, so I have a good feel for the regulatory frameworks here, and then also in Europe a little bit as well. So that's me.
Good to see
And
you,
my
buddy.
background is kind of interesting in the sense that I wouldn't say interesting, but it's relevant in the sense that we're talking about very similar kinds of things in the crypto principles that are used or required with regulated companies. And I've started 4 regulated companies in my day, 2 in the UK and 2 in Canada. So I have a bit of an appreciation for what it takes to set up and operate a regulated entity.
Greg, it's great to have you today. Before we start, for the audience, thank you again for joining. We do take questions, so if you've got some questions for Greg or I, please put them in the chat. Greg, I want to start off. You were one of the core members. You've been with WSBA a long time. It's a privilege to have you. You were one of the core members of our Crypto Industry Principles initiative, and you were the architect of this section that we really are going to be focusing on today, which is collateral management. And it's interesting because you and I come from the world. You have a long history in financial markets, as do I. And it's almost an afterthought when we talk about proper collateral management. But we thought it was worthwhile to have its own section of crypto principles. Why was it so important to note this early when we talk about principles? And then we can dive into some more of the specifics. But I'd love your thoughts about the importance of collateral management.
Sure. I think in this sense, and yeah, all depending on where you come from, collateral means a lot of different things.
Hmm.
If you're in the traditional financial markets and repo, like collateral is what you have against your, borrower loan of cash and things like that, right? So, but in this sense, collateral means basically what a exchange or market participant does with the assets entrusted to it by customers. And I'm going to step back a tad, if I might, in that this has been a big issue in terms of what what an entity does with the assets that are entrusted to it by customers, how it holds them, and but basically the principles in general, I think, and I'm going to sort of go off a tad here, but I think the principles here, in the absence of regulation,
Mhm.
um, and regulation of the intermediaries, and there are other parts of the world that have these regulations, but the U.S. does not at the moment. Is it that the principles themselves and these subsections were meant to provide frameworks, or and at least standards for entities to say, yes, we're doing this, or not necessarily, no, we're not doing this, but yes, we're doing this, and we're sort of, and give people some comfort as to what they're doing and how they're doing it. One thing we have to be careful of here is that, unlike a regulated area where a regulated company reports to a regulator and it
Yep.
provides information, in this sense, we're asking a company to provide information um, to the public at large, because there's no regulator to provide it to. So, in a sense, we're asking the company to provide the information to the public at large, and we have to be careful here not to ask the entity to disclose the secret sauce of their business, but disclose enough that there is comfort in dealing with them. And I think that's an important distinction to make from a guideline and perspective here. So,
Yeah.
what do we mean? Why is it so important to deal with things in collateral management? Is realistically making sure that the biggest thing, the elephant in the room, at least historically, up until you know several months ago, when and we all know the names, is what an entity does with the assets that are entrusted to it. How does it use them, and does it use them, or does it not commingle them with their own assets, and does it segregate them and put them in an in a regulated custodian, and keep a certain percentage in for settlement ease and this kind of thing, right? So it really is a matter of what do they do with the assets that are entrusted to them, and how they're segregated, who holds them, what are the risks involved there, not only assessment of the entity that they're entrusting to, but what are the other sort of risks in terms of in terms of technology risk, counterparty risk,
Right.
that kind of thing.
Yeah.
Many companies are doing this already, so we're not asking them to do anything that many are not. What is being requested here within the guidelines and principles is to say, yes, we are doing this, and disclose that clearly and distinctly, so that people can be comfortable when they're dealing with them. And that's not, again, it means not just customers who have put money in, but it also goes along to the fact that other stakeholders would like to know that these certain entities are, what they're doing and how they're doing it, just to maintain comfort. Investors would
Right.
like to know. Potential investors would like to know in the entity. Regulators and wherever else would also like to know. Institutions would like to know that aren't dealing with these people. So that's kind of why we thought that it was important to start
Greg,
off with this kind of stuff.
yeah, Greg, thanks so much. Again, coming out of TradFi and having the experience and background that we both have there, we're almost used to the conversations around collateral and collateral management. But one of the things, we note very specifically in that section of our principles that customer assets held directly or through intermediaries. I want to get a little more granular on that, and we don't necessarily need to name firms particularly, but we saw some pretty egregious use of customer assets as part of the collateral process. I want to peel back the layers of that just a little bit. What were some of the things that you had seen, let's call it the past 2 years in the crypto space, that were setting off red flags for you, for example?
Well, once again, I think it just comes down to disclosure as to where the assets are, who controls them, and whether or not they were used by the firm, by the entity. I'll call it an entity, in business that was undisclosed to the customer, and were there risks that that the customer was undertaking that weren't disclosed. Um, so I think that I'm not sure if there were specific red flags,
Hmm.
but I think there are certain entities that are very, very good at this kind of thing, and they do provide such information, and they do say, okay, yeah, we do hold this, or we hold that, or we don't, or we hold a certain percentage of our total assets in sort of on exchange wallets to be used for settlement and clearing, as opposed to held in what we call custody. um, and again, it comes back to what is being disclosed to the stakeholders
Hmm.
and the customers. So held directly, which mean on exchange, or indirectly through a custodian. Again, and there are places now that will um, that will mandate, by regulation. Canada one, for instance,
Right.
um, that says, okay, you have to hold a certain amount, or you represent to hold a certain amount, at qualified custodians. They have, and they provide that list, and those qualified custodians have to have certain, levels of competency, SOC 2s and SOC 1s, or whatever else, and be regulated, where they are. So there's a lot of places where you can go for this kind of thing. And Mika, I believe, also does the same thing.
Right.
Um, but again, in the absence of regulation and the absence of guidelines, as to how to do this, so that you're mandated to do so, um, you know, it's a matter for the entity, hopefully, to provide that to, for clarity and safety purposes.
Right. Greg, and to that point, and for the audience, Mika, we're talking about markets and crypto assets. the European regulations around the crypto asset markets. And interesting, Greg, a lot of what you're speaking of kind of belies this underlying, I don't want to say mainstream media perspective, but this narrative of critics in the space that, well, no one's doing disclosures, no one's managing collateral properly, and they point to the glaring examples. But if what I hear you're saying, if what I'm hearing is correct, and I think it is that there are participants in this space, not just in TradFi, that are trying to do the right thing by way of disclosure, by way of collateral management. Would you agree with that? And
Yeah,
is
of
that an
course.
increasing proportion? Yeah.
Yeah, of course, of course. I think most are, yeah, most are doing the right things.
Right.
And certainly any, any larger exchange, and we know the people that work and run the largest
Yep.
exchanges, yeah, they hold themselves out to be as compliant as they can or need be within, within the, within the regulations that are required. And then on top of that, here is what we do,
Right.
to make sure that, that trades are done properly, that settlement is done properly, that the custody is done properly, that we disclose risks, and that if we offer certain things like staking or lending or whatever, then, how is that being offered? What are the risks to you, in respect to that, and do you indeed have the ability to select on that? We don't just do it for you. Some might,
Mm-hmm.
and that's been the structure that they've decided, or some may not, and they just, okay, look, you want to participate in these things, then here, you have to select, and you're asked every time you do so, that are you sure you want to do this?
Yeah.
Are you sure you want to, like, you know undertake this activity, and fine, and then again, it's a matter of providing the disclosures that are required. But I think most of them are doing that. And again, for the ones that I know, well, and the people that I know at them well, yeah, they're of the utmost character and of the highest individual standard, and expect that to carry through to the corporation as well.
Greg, thanks so much. I want to, I often do these on these sessions, and I'm pretty sure you're going to text me later angrily. I'm going to rip up the script
Mm,
a little bit. And from the perspective of prep, one of the things I want to dive into a little bit, and we talk about quality of collateral. I want to talk about the quality of collateral. And the reason I'm bringing this up, and you're very aware of the quality of collateral across your career. One of the examples, obviously, is there were exchanges and there were participants in the space essentially creating their own tokens and calling this collateral, which you and I know wouldn't fly in the world of TradFi and historically the worlds that we come from. Do you see a quality of assets problem when we talk about collateral in the space? And is that improving in the crypto space? Any thoughts on that?
hmm that's a good question. And I would think, again, if somebody is um is is using assets, or somehow monetizing or hypothecating assets of customers in order
Yep.
to generate, uh say a stable coin, for instance, where it can then turn around and buy, an affiliated asset or something. Again, I think we all know what we're talking about here. I don't want to go into
Sure.
names. I think it's dumb. um so, i- in a sense, the quality, damn it, it really does come down to what I'm doing with the asset. Like,
Right.
if I've given you, if if I'm custodying, or if I've got Bitcoin in my account, then unless I've asked you to do something with it, or unless I participated in a DeFi protocol, or unless I've lent it out somewhere,
Mm-hmm.
or whatever I expect that to be there.
Yeah.
If you're using it for something else, to prop up the price of your own token, or to create something else, then clearly that is not a good thing.
Right.
So, yeah, but I'm not sure about the actual quality. I think it's the use. So perhaps
Yeah,
I'm not
and it
answering your
comes back
question
down to
correctly.
disclosures as well, right? It's if you're disclosing what you're doing with customer funds and the assets and how you're managing collateral,
Yeah.
describe what the collateral is. If it's, Ron token that you created the other day with no
Right.
market value, that's a very different thing than we've got Bitcoin or we've got deposits and holdings of treasury to back up a stablecoin that we leverage as collateral.
Yeah.
So it's part of
Well,
that disclosure.
right. And if I've done something like that and I've actually purchased Ron token,
Don't do that.
then I'm taking market risk that I don't necessarily need to take.
Yeah.
Or if I'm participating in something else, if I'm lending it to somebody else for a certain purpose, whatever that purpose may be, I may not even know the purpose. Um, then you have to look at the counterparty risk. You have to look at the credit risk. Again, with something that we're used to on a regular basis. So yeah, those are things that will be inherent in the disclosures, and it doesn't even come down to quality of collateral at that point. It comes down, okay, I'm going to participate in a DeFi protocol. I
Mm-hmm.
can get X% from my Bitcoin over here, and I can get Y% over here. Well, where where is the what is the risk of getting a higher rate? There has to be something.
Yeah.
It or there should be, or the likely is something. And how do I disclose that? How do I get that out there, or at least understand it from somebody, that there might just be there might be credit risk or counterparty risk that is unintended
Yeah.
or not understood particularly.
Yep. Greg, thanks so much. And for the audience, again, thank you all for joining us. If you've got questions, please enter them in the chat. And to reiterate, there is no Ron token. Shout out to my friend David Brill, who would laugh at me for talking about Ron token.
You
And this
tried
is
though,
not.
didn't you, Ron?
I did not try. And this is not accounting, investment, legal, or tax advice.
Oh, yeah, right.
Greg, you started a point on that I think is very, very important when we're talking about disclosure and we talk about associated risks. And I want to paint a picture a little bit, because you mentioned very specifically lending and staking and the other services that are available in the crypto asset ecosystem. And the joke, and it's probably a bad joke, but when we look at things and try to find like options, right? You and
Mhm.
I know the options markets, tons of disclosures, tons of risk disclosures. If you're in the United States and you open an options account, you get a big fat piece of document that is the OCC description of risks in options trading and investment.
Mhm.
And I would argue that no one reads them at all.
No.
So we talk about disclosures from the perspective of, look, these are participants in the marketplace. They're selling services to customers that are crypto asset based services. Disclosures are important. Will those disclosures be ignored by the marketplace? And we're digressing a little bit, but I wonder, it's one thing to tell industry participants you have to create disclosures. You can't make people read the disclosures. So then becomes the question, what good are they?
Well, if there was a regulated, yeah, right, exactly, yeah, long heavy sigh. If there was a regulated framework that required disclosures, and and of course, if you do that, then the customer that may have lost money or whatever, really doesn't have a leg to stand on when they try to sue a brokerage firm for losing money.
Right.
If you adhere to those, and I remember working for a Canadian retail brokerage firm some years ago, longer than I care to remember. Um, and their legal department spent the inordinate amount of time dealing with investor lawsuits, because they felt that the investment recommended by the broker, and I'll be back to that,
Yep.
was not suitable for them. Now, the interesting thing here is that in this case, or in these cases here, is that exchanges, and we'll talk about exchanges specifically here, exchanges act like broker dealers and and exchanges. They don't necessarily, it doesn't come into one pool exchange. So they act as much like securities dealers and broker dealers as they
Mm-hmm.
do exchanges themselves. But of course, there's no individual broker that you're talking to. There's no manager. There's no person to explain to you what you're investing in, what you're doing.
Right.
You still have a responsibility, and you should read the disclosures and this kind of stuff, and the option agreement that you sign when you open up an options account. But again, nobody does. um but that's your fault. I'm sorry.
Yeah.
um and all you can do is provide the information to somebody, and if you don't read it, then
Yeah.
okay.
And in a way, disclosures like that are standards of business practice in the space, as well as depending on the jurisdiction, regulatorily required. They're a little bit of gate stoppers in my mind. Like I know colleagues who are retail investors who see the disclosures briefly. That's not a market for me. So I think in the
Yeah.
existence alone of those disclosures, I would argue shows a seriousness on the part of crypto asset participants.
Well, yeah, in the traditional way, I guess, and some people seem to think that because it's been around long enough, they seem to think they understand the risks,
Right.
that they understand risks of selling a put option, um, and they understand what pin risk is, which of course
Yeah.
they don't, and things like that. And if they so they kind of don't need to read them. Um, but of course they know they don't understand blockchains necessarily.
Hmm.
They know they don't understand the particular protocol or the token that they're buying and exactly what it does, except
Yep.
for save for Bitcoin perhaps. And then of course there's again the individual entity that is providing the service, that okay, like what are they doing? So yeah, there's on. And it's interesting that Mika most recently um required a exchange as part of the listing process of a token
Hmm.
to provide the white paper as part of the disclosure on the
Right.
particular one. Now, that doesn't say that they have to approve it or that the regulators have to approve it. But of course, most exchanges, if not every exchange anywhere in the world, is going to review the white paper and make the determination, largely the determination as to whether it's a security or not in the United States uh, under the U.S.'s definition of a security. Whereas Mika doesn't say that. It says, okay, you have to provide the white paper as as part of your disclosure for people to read.
Right.
You don't have to approve it. You don't have to do anything. You have to make commentary. Nothing. You just have to provide the white paper. So at least then you're providing, and which is largely like a prospectus, but it's not. So at least they're mandating that if somebody does want to find information on the particular cryptocurrency that they're purchasing, then they can find it. Make it easy
Right.
for them to do so.
Yep.
I don't know if anywhere else does that. I know Canada doesn't.
Yeah, I don't know. And it's interesting. We have this conversation with colleagues. It's a crypto white paper as preliminary S1 filing
Right.
document for a securities offering, which I'm sure would make
Well,
some crypto heads explode. Go ahead.
there's another thing that is probably begging for a little bit of standardization. However, that's not for this discussion.
No, that'll probably be its own standalone session, my friend.
Probably right.
I want to talk a little bit, and thank you for that, Greg. You're based in Canada. You and I speak frequently. We've got colleagues throughout the U.S. We've got colleagues at the WSBA in Europe and some in Asia as well. One of the focal points we had when we look at collateral management, and indeed all of the sections of the crypto industry principles, was this nonpartisan, almost regulation neutral perspective. And I wonder, is this an opportunity? I'd love to hear your thoughts. What's the Canadian perspective on the crypto asset market? I'm tearing up the script a little bit, but you're involved in it on a day-to-day basis.
Mhm.
Is it more workable in Canada generally than you see in the United States based on the conversations we have?
Yeah, I think so. Um, well, fortunately for us, we don't necessarily have this partisan view of of whether or not rails. We don't have the same requirements that you guys have down there with respect to, look, if you want to do something, then Congress has to enact legislation. No, we don't.
Right.
Um, we, s- we do have a little bit of a weird situation here, though, is that every province, of which there are 11, have their own securities regulator.
Right.
Now, the largest ones would be the Ontario Securities Commission, the BC Securities Commission, and the Alberta Securities Commission. Quebec is in there too. Um, they have all gotten together and realized that they cannot necessarily look at each individual token that people want to purchase and sell and determine whether or not they're a security or not. And I don't. And we have a similar test in Canada to the Howie test, by the way.
Yeah.
That is typically here. That is almost identical. So what they did is they took the form of, all right, we're going to make sure that at least if people want to invest in these things, that people have the opportunity to be comfortable that they're investing through a regulated entity. or they're using a regulated entity to do so. And so there was a there was an ill-used or not well-used area of securities registration called a restricted dealer.
Mm.
Don't know why it was there, but it was, and not many people used it. So they basically pigeonholed, or they ring fence that to be the crypto kind of thing. So anybody who wanted to operate a crypto exchange in Canada would have to file a registration to be a restricted dealer in your certain province. Now those are run by the provinces. If you haven't filed or haven't received approval, then you would file what is known as a pre-registration undertaking. So you had filed a registration, but here are your undertakings with respect to how you are going to conduct your business. And these are publicly available through the Canadian Securities Administrators website as to who has filed, who has received approval as restricted dealer, and the pre-registration undertakings that they have provided. Many exchanges that you will recognize have filed them. Canadian exchanges such as WonderFi and CoinSquare and
Mm.
Virgo CX and Bitvo and others have, and then international exchanges have also filed. Coinbase, Kraken, Gemini. I can go through a handful of others.
Yep.
Um, so and then so at least there's a regulated framework. Okay, this is what we're doing. This is what we have to do.
Yep.
And again, it acts very much. You have to file your monthlies and this kind of thing, but you file them with the regulator, not with the public at large. But you're filing with the regulator, and there's certain tokens that you can't do. Funnily enough, you can't actually trade or offer to trade for your customers stablecoins,
Interesting.
because you're not allowed to trade securities, and the Canadian Securities Administrators or the regulators have said so far, and there is pushback on this for sure, as you would expect, that a stablecoin is a security just based on the complexion of it.
Yeah.
So you can't trade securities and derivatives, but you can trade crypto contracts,
Right.
which are it's a kind of a thing where, okay, I can trade in crypto contracts, which are cryptocurrencies. It's just that you can't. Anyway, you're trading crypto. It's the same damn thing.
I feel like we're talking about an ARB opportunity across
No, there's
different
no ARB
venues.
opportunity. It's just the way they've worded it and stuff
Yeah.
like that. And then from there, though, what is interesting, and this is something I think that is really unique. Firstly, already in the world, and Mika is sort of coming to
Yeah.
this, but it's also very unique in the world. And again, it comprises disclosures. But then the restricted dealer and the agreement to be a restricted dealer then comes with a caveat. Within a certain period of time, you have to file for and achieve IROC registration. Now, IROC is the Canadian version of FINRA. So let's just leave it at that. So that's a national self-regulatory organization. There's only one or two companies that are crypto companies that are IROC.
Mm-hmm.
But once you're there, then you've reached the level of being a securities dealer, or a dealer on the same level as any other major broker dealer in Canada that you would happen to know.
Yeah.
So at least there's a framework, there's a path, and that helps a lot. I think it helps a lot in terms of making sure that with whom you're dealing, there is a matter of A, trust, and B, standardization, that certain things are done. And
Yeah.
part of that is commingling of assets, or not allowed to do that,
Yeah.
and where and how much of the assets that are entrusted with you have to be held at custodians, and the rest can be held on your own book in order to facilitate clearing and settlement of
Right.
trades.
Greg, thanks so much. I always love hearing the perspectives outside of the US because there is progress happening in our minds across different fronts, and they're models for what can
In
be done in this space.
Indeed, absolutely, absolutely, and then yeah, and and maybe in the wake of certain recent court decisions, this will change in the U.S. as well. I don't know.
Well,
We'll find out.
you and I will probably have that conversation every week for the next couple of years, but we'll see. We'll see where it goes. We don't have a lot of time. Greg, I want to hit on one more point that we raise as part of the section called collateral management. pardon me, and we had noted that segregation of customer assets with qualified custodians. And I want to peel that back a little bit. When you say qualified custodians in the US, a bunch of regulatory lawyers' heads will explode because it's a very different perspective or very specific perspective on qualified custodians. The SEC has weighed in on making some restrictions around what could be qualified custodians. What's your expert perspective on what a qualified custodian is in this space and how important they are?
Oh goodness. All right. Well, first, you're not going to get an expert opinion as to what a qualified custodian is, Ron. I'll tell you that right now.
That's fair.
Um, I actually don't know what the definition is particularly. I'm
Sure.
not going to say I do. So I'm not going to say that. There are ones that are regulated.
Yep.
So, Coinbase custody is regulated, or the
Right.
Gemini is regulated, the custodial section, and others that are not affiliated with exchanges and stuff are also,
Yep.
BitGo and others. And many of those many of those have, if not all of them, would have certain levels of, security, SOC 2s, SOC 2 type 2s, and whatever. So I think it's a matter of whether there's an explicit definition of a qualified custodian or not. I
Hmm.
think depends on the individual regulator,
Yep.
and some of them may be prescriptive in terms of where that custodian has to be. Um, but I think in terms of this discussion, I think it's incumbent upon entities to, and they all do, or not all do, but they in general they do. They
Yep.
review the custodial relationship, they review the security under the custodian. They are doing their utmost in order to make sure that that custodian is not only safe and secure and compliant and whatever else, but that there's a measure of insurance as well, so that if there's an issue on that
Right.
side of it, that they have insurance. Again, all of that, again, many best practices are being undertaken at the moment.
Yep.
Just if if we're not being made aware of it, then we should be made aware of it. And those kinds of things are great advertising
Right.
for an
Right.
entity. We deal with this person, and this is what they are, this is what they do, this is the insurance they have, so that the safety and security of your assets is well and truly taken care of. Is it guaranteed? Of course not.
Right.
Is it taken care of to the best of our ability? Yes, it is.
Yep. And Greg, to that
Maybe that's
point,
it.
when I hear qualified custodian, that's a call for customers of these platforms to ask those questions themselves, right? What is that
Hmm.
custodian doing
No
on
way.
behalf of my assets? How are they managing it? So it really, for me, when we talk about qualified custodians, it's also a shout out to customers to do your own homework about what's happening in this space, because there are participants in this space that I probably wouldn't put money on, but there are participants in this space that are doing all the things you're talking about around
Right.
proper collateral management, proper custody management, proper disclosures, proper risk mitigation as well.
Yeah.
Greg, thank you so much. I know we're just about out of time. It was going to be one of our briefer sessions. You and I will continue to work on putting the message out there. We're working on release 2.0, which gets even more granular on specific things in the crypto industry principles. Greg, any closing comments from your perspectives on collateral management, its importance, where we see this going?
Um, no, I think not really anything more than what we've discussed. I think there's a lot of other things that are as important. But what I think is interesting is that, just for people to understand or be able to have the information available to them as to what is being done. Assets are not commingled. What is interesting here? Actually, one thing that I've forgotten to mention is that from a from a again, we'll talk about exchanges particularly. There is nothing at the moment, except perhaps in Mika, and I can keep calling it Mikar, Mika, in that there has to be a minimum capital requirement for the
Mm,
exchange. Um, there isn't anything in Canada in respect of that as to minimum capital requirement. But actually, having said that, you have to have a minimum requirement to be a restricted dealer in the first place. So there is one, but it's relatively modest.
yeah.
Um, and there's no sort of relationship to customer assets versus capital that I'm aware of.
Hmm.
If I'm wrong, I'm happy to be shown that I am. I think that's an important thing. I think that's an important aspect of it as well.
Yeah.
Um, but so I think that would be something that I would sort of finish off with, and think about that kind of thing
Yeah.
going
It's a good
forward,
point.
perhaps.
It's a good point, Greg. Thank you so much. And again, overarching commentary for market participants in the space. The principles-based approach we're looking at is critical to evolving the ecosystem for customers looking at things like this. Understand and ask those questions about collateral management and custody and what's happening with your assets. Mr. Murphy, as always, old friend, it's great to have you part of this. For those of you who tuned in, thank you for joining us. Recording will be available on the WSBA YouTube channel next week if you missed us. And please join us again next week where we'll be tackling cybersecurity. Greg, thank you, buddy. Good to see you. We'll chat again soon.
Thanks, Ron. Appreciate your time. Thanks, everyone, for joining. Enjoy
Thank
this.
you. Bye-bye.
Cheers.